Hi, everyone, and welcome to the NCAT ATRA webinar, Crop Insurance and Hemp, a Whole Farm Approach. My name is Rich Myers, and I'm an outreach specialist for the National Center for Appropriate Technology, which we always say is kind of a mouthful, so most people just know us as NCAT. NCAT's a nationwide nonprofit organization. We're headquartered in Butte, Montana, and we have 5 regional headquarters across the country. We work on issues pertaining to sustainable agriculture, sustainable energy, and sustainable communities. This webinar is being recorded and it will be available on NCAT's ATRA webpage. ATRA, a Sustainable Agriculture Information Service, is funded through a cooperative agreement with the USDA Rural Business Cooperative Service, and we're grateful for their support. ATRA offers a wide range of services to sustainable ag producers, including publications, toll-free helplines, videos, podcasts, databases, webinars. You can check it out for yourself after the webinar on the ATRA website at www.atra.ncat.org. That's www.attra.ncat.org. Today's presenter is Jeff Schahczenski. Jeff serves as an agricultural and natural resource economist in NCAT's headquarters in Butte. And Jeff's been working on the whole farm approach to insuring farms for 14 years. Before moving to Montana, he worked for Rutgers University, started one of the first community-supported agriculture farms in New Jersey, received graduate degrees in agriculture, economics, and political science. He served in the Peace Corps in Belize, and he worked on his grandfather's dairy farm in his native Wisconsin. But before I get to Jeff, there are a couple of things I'd like to point out. First, you'll see a field on the screen where you can write questions during the webinar. I'm going to be collecting the questions, and Jeff will answer a number of them toward the end of the webinar. And don't be shy about asking questions. The more the merrier. If you ask a question and it isn't answered during the webinar, we will answer it, and all the questions we get via email in the days to come. In fact, if you think of questions about after the webinar or about any sustainable agriculture question, look for the Ask an Ag Expert contact information on the ATRA website. And also, at the end of the webinar, you'll receive a short survey and would ask you to please take a few minutes to answer the survey. It really helps us make future webinars as effective and helpful as we can. So anyway, it's time to get started, and I'm going to turn things over to Jeff.
Good morning, everyone, or I should say afternoon, depending on what part of the country you're joining us from. I am trying to advance my slide and not having success, so I better. Does anyone know why I'm not advancing my slides? There it is. Maybe I didn't wait long enough. Anyway, the outline for today is to look at insuring hemp through the Whole Farm Revenue Protection Program. And I'm going to also talk, because it's necessary, I think, to talk about whole farm revenue protection in general, and how to request an insurance and the whole farm revenue protection quote for insuring hemp with the whole farm. And I'll do a brief case study, some take homes, and please remember to take the post-webinar survey, because that's critical for us to improve these webinars over time. I've been working on the whole farm approach to crop insurance for 14 years. Some people might think that's crazy, and sometimes I think I'm crazy myself. But it is a very unique way to look at crop insurance, and it has particular, and it's fairly new, although it really has been around since the 2014 Farm Bill, and really before that, but it is a unique way to insure the revenue of a whole farm. I will be using some jargon. I know that over these many years, I just start assuming that everyone knows crop insurance or insurance jargon generally. It's not always true. Liability, pretty simple idea, but the value of what is insured, it's never 100% in crop insurance, and many Many insurance policies have deductibles. They don't give 100% payout for what you are insuring. Indemnity, maybe a less used term, but the value of the payout or for an insurable cost, basically what you get paid for being insured after a loss has occurred. Premium, the cost of insuring. That's a little bit different in crop insurance because premiums are very highly subsidized under the federal crop insurance program. Roughly in 2018, it was about 64% of all of the premium costs of the insurance program were paid by taxpayers, and the farmers paid the balance. So there is kind of a farmer premium and the whole premium. We'll see that later. Revenue insurance, this is very important. People often miss the difference because most people think of crop insurance as insuring a single crop like corn or wheat or soybeans. But really, revenue insurance is about yield risk and price risk. So, you'll have, and yield risk is often referred to multi-peril insurance, meaning there are multiple perils that can affect the yield of your crop, and that's what you're insuring against, the losses from yield loss. And there's also price losses. When you plant your crop at the beginning of the year, you have an expectation of a price, and that may be very different at the end of the crop year. And so you take some risk in that the price will change during the crop year. And so when you take price times yield, you get revenue. So you insure both risks. There's really also, and this is really unique because whole farm is unique, most crop insurance people think of this, again, think of a single product like corn or apples or something like that. You're insuring your apples or your cabbage or your lettuce. But whole farm revenue is protecting the revenue of the whole farm no matter what you grow. The basic idea of it is that essentially the farmer or rancher decides what they want to produce, what is most profitable to produce. And with this policy, based on your revenue history and your current expectations of revenue, you basically get some percentage of that revenue protected should a revenue, price or yield risk occur to you. So you're insuring the revenue of the farm, not a specific crop. That has all kinds of implications, and we'll discuss some of those later. A loss ratio, I'm not going to use this very much, but it's the indemnity divided by the premium. You can have a loss ratio that's for you as an individual policy. In other words, and really one way to think of this is what is indemnity, what is paid out by what is paid in. So if you had a loss ratio greater than 1, it would mean that more was paid out than paid in. It's kind of important for the crop insurance program because the idea is to set premium rates so that the loss ratio is approximately 1, meaning in a way, crop insurance functions a little bit like a nonprofit. We want to set premiums so that we're not making money. In this case, what we're doing is we're basically charging what we expect to get back. And of course, it's not true in any given year, but over time, the idea is to pay out no more than you take in. The other thing to remember about whenever I talk about this more, that crop insurance is not the only way to mitigate the risk of farming. And I'm not here to sell crop insurance, even though sometimes I get accused of that, particularly accused of whole farm revenue selling, but I do like the policy. You might not need to buy insurance. You can reduce risks in many different ways. Diversification itself, and that's kind of important, we'll talk about that later, can be a kind of insurance. You can replant a crop that dies early. You can actually get that partly covered under whole farm, and a lot of crop insurance is called prevented planting. You can build a bin, store your crop, and then wait for the best time to sell it if you have a storable crop. Or if you are well off and you have a good savings account and you basically can suffer loss and sustain yourself financially. Many ways to lower risk. And I also am not discussing here the current interim final rule for the USDA hemp program. can see that, and it's kind of evolving. It really is only very recently that this rule was published, the very end of October. I have read the rule, all 140 some pages of it, kind of understand it. It is going to be a work in progress. It was passed in the Farm Bill. It took about a year to start to get the implementation rules out. These are interim, meaning they're going to be what the rules will be for next year, but they may change in the future. So again, whole farm revenue is unique. It's not, again, insuring any specific crop. And the way to think of this is that hemp can be insured as one of the products that contributes to the revenue of the whole farm, not essentially insuring it by itself. So for hemp and crop insurance for the 2020 crop year, whole farm revenue protection is the only way to insure the crop. And hemp can be insured as a fiber, a flower, or seeds. There are many different and multiple uses of hemp, and people are growing it for different purposes. And you can actually be growing it for fiber and insure it as fiber or as a flower or as a seed. Other hemp, there are some restrictions that are unique to hemp and unique to its use in whole farm. Producers can now purchase coverage if they have a contract for the purchase of the insured hemp. That's important. You have to have a contract. So if you're going to insure it in 2020, you need to establish a contract for the purchase. And that's important because that will establish a price. And remember, revenue is price time yield. So the price needs to be established, and it will only be insured if it's in a contract form. That's a big limitation, but it is. And you need to meet all those applicable laws that were in the interim final rule, which I'm not going to go into. Another key provision is that hemp with a THC, I can never understand what THC, it's a big chemical name, but it's the psychoactive ingredient. It's essentially now the legal definition difference between industrial hemp and marijuana, and that level is 0.3% or lower to be hemp. If it's above that, it is not hemp. And there's a compliance, and this will not, I put in red, will not constitute an insurable cause of loss. This is somewhat controversial because there is some effort and difficulties in necessarily making sure your crop stays below that THC level. And if it doesn't, you have to basically destroy it at your cost and not an insurable loss. So that's a really important, and that might be one of the major risks of growing hemp in the coming years. Hemp is not eligible for otherwise available prevented planting. I was saying you can sometimes get insurance if you have to replant, but it's not. It is for all other crops in whole farm, but not for hemp. And RMA is looking at other ways to insure hemp producers. Probably the biggest one will be some kind of single crop policy. We'll talk about that a little bit later too. So if it's not grown without a valid marketing contract, it's not insurable. And it's even a little bit more important to think about this carefully. Some folks might contract, for instance, half of their hemp production and then wait to the end of the year and sell it to the highest bidder or wherever else they can sell it. Well, essentially what this means, and it's a little bit confusing when you get to lingo of crop insurance called revenue to count. What this essentially means is basically in this case that I give this little example, that 50 acres that is contract will really effectively be the only part of that is insured. So in other words, you're only insuring that which is in fact contracted for. So if you really want full coverage over your crop, it will be best to have a contract for the whole production. And again, at the THC level, I just want to highlight that again. It's not, again, an insurable cause of loss. Even if the farmer did everything they possibly could correctly in growing it and had great expectations, used the right seed, grew it the right way, and whatever, and it came up higher than that, then you are out of luck. Again, almost any crop or livestock product, the exemptions are no show, sport, or pet animals can't be insured under whole farm, and none of the forest products. It's important to note that this is also about the raw agricultural product. In other words, a simple way to think of that, they insure grapes, but not grape jam. So if you have added value processing on the farm, only the raw part of the product can be insured. Again, grapes, not grape jam. It's available in all counties in 50 states. That's roughly 3,300 different counties. It is the only crop insurance policy that is available in every county in the United States. That is unusual and unique. A lot of crop insurance policies for individual crops aren't available in your specific county. I'm in Montana and I grow tomatoes, but I can't insure tomatoes as tomatoes in Montana. If I live in certain counties in California, I can. So there's limitations, geographic limitations of individual crop policies. Whole farm, because it's really not about the crop, it's really about the revenue, is available in every county in the United States. And again, any marketing channel, any combination of ways you sell it can be insured. It doesn't have to be only a wholesaler, retail and direct marketers can use it, and any combination thereof, again, because it's really not about the crop, it's about the revenue. Here's some brief statistics for 2018. 2019 isn't quite over yet, so I didn't give you the most recent data. 2,500 policies, so it's not a hugely used program yet. It does insure quite a bit of liability, i.e. the value of what is covered, because in a sense you're covering the whole farm, which then can add up to quite a bit of value. You can see the 72%. I mean, the premium, the premiums, the subsidy rate is fairly good for whole farm revenue. These vary by policy, average 64%, so it's doing better than the average. And you can see the millions of dollars indemnities paid out. And this, remember I talked to you about loss ratio. This is the farmer loss ratio, and what is 2.9, again, greater than 1, meaning for every dollar in premiums paid by the farmer, on average, $2.90 was paid in indemnities, on average, not in any individual. Again, based on all crop and livestock products. And again, that's another unique thing. This is inclusive of livestock products, which is, again, unusual. In fact, there's not a lot of, not many kinds of livestock insurance. So this is one which includes that, again, because it's the revenue. Premium rate discount increases with each added product up to 7 products. What that means is that it incentivizes diversity. This is one of the main reasons I've been so interested in this, because in my mind, a little bit more diversity in agricultural production systems, I think, will lead to more sustainability and resilience. And this, unlike other crop insurance, incentivizes. So in other words, the person who grows 7 products rather than 4 will get a bit of a discount because of for each added one up to 7. Now, why it doesn't go beyond 7, it's been interesting. I think it's just the way it was set up. There's no real reason why it couldn't go higher, but it doesn't. And there's 5 years, and again, this is probably really important. I should have started out with. You have to have a minimum of 5 years of submitted tax forms if you're not a beginning farmer, or 3 years of those if you are a beginning farmer. And for this policy and this policy only, whole farm revenue defines beginning farmers, like most of USDA does, by 10 or less years of farming. It's important to identify yourself as a beginning farmer. You get a discount under whole farm, being a discount farm, beginning farmer, and again, you only have to have 3 years. But the bottom line here is, if you're a brand new farmer in your first year, never submitted a tax schedule form, there's no way to analyze your revenue history, your expectation of production. So really, you can't set up a whole farm revenue if you have no history or experience. And it covers a liability up to $8.5 million for crops and $2 million for livestock and nursery. So if you go above that value of crops and or livestock, in terms of what the insurance part of that is, you can't use whole farm. Here's a little bit more detail on that. Also, like all crop insurance, you often get a choice of what level of coverage you want, just like most insurance. You can choose and pay for it. And generally, the higher the level of the coverage, the higher the premium. Just logical. Now, this is set up with 5% increments from 50 to 85. So if you want a really low valuable, a low premium cost product, you could insert up to 50% of your approved historic revenue, and that would be a lot cheaper. The other thing I want you to know is that notice on the right-hand side they have that maximum farmed approved revenue, and it looks like bigger than 8.5 million that I just told you. But remember the difference between liability. So if you just take the 85% coverage level, multiply that times 10,000, you get, of course, your 8.5 million. Also note that to get the higher 80 and 85% coverage levels, you need to have more commodities. If you have only one commodity under crop insurance. Now, this is also a little bit of a confusing, it says one commodity and this is supposed to be a diversity program. Well, the rule goes something like this. You can have a one crop whole farm revenue policy. It is possible. You can only get up to 75% coverage level with that. And that obviously relates to a maximum amount of approved revenue, as you can see in the slide, but it can only be one if you live in a county where there is no alternative revenue for that crop. So let's say you want to get a whole farm revenue product out on cabbage, and you only were growing cabbage, and in your county there's no revenue policy for cabbage. You would be eligible to, even with one product, to take out whole farm revenue protection. Now, this does have implications for hemp, because there may be some folks out here who only want to grow hemp. So as I read the rules, and maybe it's a bit of a technical detail, but it is not possible for one to get an alternative revenue policy for hemp, because there simply is none. That would imply that you could, with the lower level of coverage, 75% below, in fact, insure your hemp product crop with only hemp at that level of protection. Again, whole farm is sometimes the only option for many crops and livestock products in specific counties. As I said, I can't do tomatoes in Montana, but I can do whole farm to insure my tomatoes. Provides insurance for diverse operations. I mean, it was really more designed, again, with the incentivization of greater diversity. The program was designed to deal with lots of crops that are mostly what we would call specialty crops, that are not often available for single policy, and for diverse operations. It's also unique, and I've been interested for this reason too, that it inherently embeds the organic value. If you've been an organic farmer for a number of years, let's say the 5 years necessary to apply, and you've always been a growing organic, and you've always been getting that generally higher organic value for your crops, the organic value is embedded in your revenue. Being embedded in your revenue, you are getting the coverage, that higher coverage level for the value of what you have. And again, crop insurance, another important reason many folks do use crop insurance is that it can be used for qualifying for a loan. RMA has a very special fact sheet that in fact is for whole farm revenue that is designed for bankers. You can get it off their website, and that will you can take it to your banker. So whole farm revenue can be used as a legitimate way to insure a crop and should be recognized by financial institutions. And you can take that flyer in just to show them, because they might not be familiar with it. Again, to insure a general insurance quote, if you haven't used crop insurance below, they have a great tool on the RMA website. I just gave you a screenshot of that. You can actually locate the nearest insurance agent to where you live with that tool. Again, to get a whole farm revenue quote, you're going to need those tax forms. And usually farmers use what is called a Schedule F, or its equivalent. Now, if you don't you don't use the Schedule F as your tax way of doing taxes, you take it to your crop insurance, they can easily convert that. They have a method of converting your form of taxes into a Schedule F equivalent, they call it. So that's something you don't have to hassle with. You just have to have tax records. Again, 5 years, 3 years of beginning, and you need to. And this is the hardest part. You need to have. You need to start filling out and have the records to show your yield and price expectations, i.e., ultimately your revenue expectations for the year of insurance. And usually most of those are based on your farm's history, your sales records, your production records, and or valid 30 parties if it's a new crop. And again, it's going to come up with an approved average revenue historic, and expenses are also included. I don't want to get into this too much, but an unusual aspect of whole farm, and one we haven't been really, not really sure, it's very unique to whole farm revenue, is that they also need to track your expenses. And technically, in the year of insurance, if you do not expend more than 70% of your historic average approved expenses, you will be given a less indemnity payment. It's a kind of a fraud protection, the best I can understand it. It's the only crop insurance policy that requires documentation of expenses. It's a very unusual aspect of whole farm. And an example, this is beautiful Montana, where I live. I'm very lucky to live in a beautiful, beautiful state. This is just a case study example. Whole farm revenue is because it's dependent on your revenue history and your location, and the combination of products you grow and produce is unique to you. You can't easily just take this example and throw it up there. So you really need to go work with an agent. The premium cost obviously will be different. And again, the cost will depend on your level of coverage. I'm going to use 85% in this example just because it's the highest level, just to give you the example. So here's a farm in Hill County, Montana. Hill County, Montana is literally on the border of Montana, right in the center of the state of Montana. It's one of the more difficult places to grow anything, and particularly dryland farming. If any of you guys know about dryland farming, this is actually an organic farm. This data is not exactly a particular farmer's, although I have many farmers I work with, particularly some organic farmers who've shared some of their histories. And so this is not an unusual acreage. It's a little bit average size farm in Montana. I know that's a big farm, but that's average in Montana. And this variability you see in their approved gross revenue is quite extensive. And you can see that, there's a couple bad years and a couple good years, and it's different for everybody. But this relatively high level of variability is not unusual for a farm in Montana anyway. Yours, of course, may be different. And this is something I'll spend a little, this is just giving you the example that I used. We have 5 different crops. So it's a relatively diverse farm. Wheat, winter wheat, barley, lentils, and you see the infamous hemp seeds there, and safflower. The hemp data is, these days are really these are actual reasonable data, reasonable yields. The T yield is the county average yield for that organic crop in there. So these are realistic estimates. And the hemp data, which is, we'll talk about that again later. This is really, I drew this mostly from some experimentation works. Montana has been a pilot project since the 2014 Farm Bill. There were allowed pilot programs. Montana has been growing hemp and hemp seed in different forms for the last 4 years or so, or since the Farm Bill, and it is now one of the major producers. So this is we don't have really a lot of available yield and price data, but it's the best I could do. But it's reasonable. So this 3500 has an historic revenue of 358,000. That's just the straight average. Its expected revenue is almost 417,000. And it's important to note, with whole farm revenue, you look at both your expected gross revenue in the year of insurance and your historic, and the insurance premium and ultimately indemnity are based on that lower of the two numbers. And it's pretty normal that your history is a little bit lower than you're expected. But that can be so variable depending on the individual farm. Now, here's something that is very, very new for whole farm, and it has some implications for hemp. In 2020, as a result of the 2018 Farm Bill, and I must say some wonderful members of the National Sustainable Ag Coalition, lots of people around the country, NCAT included, worked very hard to improve whole farm revenue in the 2018 Farm Bill, and this is one of the outcomes of that work. And now for the first time, if you see the method there, the pre-2018 Farm Bill, the choice you would have was to be the lower of the two, and therefore your liability coverage. So your expectation is this 417, but your liability coverage under the pre-Farm Bill would have been 304,000. So right there you can see the max you would get is 304,000, even though you're expecting 417,000. Partly that's due to that high variability of revenue because that average then is a little bit lower. Now, in the 2018 Farm Bill, and in this for this 2020 year, you will have three options, and they're ors, they're not ands. So you can do one of three things. I call it the 60% substitution. If you remember that list, you can take 60% of the average, and then in any year where that you have an individual year that goes below 16%, you can put in that 60% number in there, thus rising the overall average to, in this case, with this example, to 328,000. So you're getting closer to your expected revenue. You can also, or you can choose to insure it by excluding your worst year of production, and then the average again rises a little bit more in this case. And again, this is a little different depending on your variability of your revenue. And the last one is if you had whole farm in a previous year, and your previous approved revenue, in this case, I just used the example 400,000, you can also insure up to 90% of that previous. Now, the choice, of course, is that there are different levels of coverage, therefore the premiums are going to be variable. And of course, if you choose the highest historic average, your premium is going to be higher. So just work along that red, because the red is the one that I would think would logically choose. Of course, you're paying higher premium, but if you look at the end, when you pay your indemnity, you get a pay. This is based, this is based on a 50% loss of revenue across the board. So your final farm revenue, net the indemnity in that column called final farm revenue, you can see with the exclusion of bad year would be 392,000. So basically, you've had a deductible, or you had to first suffer a loss of 168,900 before again you start to see the return. And then you can see that your net from that historic average is 34,000. So it gives you the best coverage should there have been a 50% loss. Of course, who knows what really will happen, but you need to run through these scenarios now. It's a little bit more complicated, but it also gives you closer. You really kind of want your approved revenue to be very close to your expectations, and there's and this really helps kind of smooth that out. And it's very unique. This is the first time this will be applied this way for this product, and I think it will really make it more acceptable and possibly used by farmers more because of that change. And what would be the alternative? Well, first, as you can see in red, there's no alternative to organic hemp seed production because there is only whole farm to insure it. So you couldn't have insured it any other way. You could do wheat, barley with revenue protections, and that's what the premiums would be for that same value. Organic lentils, where you could only get yield protection. There again, you'd still pay a premium, but only yield. And safflower, again, is only up to the 75% level. So if you try to insure these separately, they of course would cost more, and you wouldn't even have as good a coverage, in a sense, than if you took a whole farm premium, which is considerably less. Also the impact of diversity. Now, as I said, what I did is ran a scenario where instead of having 5 products, I reduced it to 3, but kept the same values, the same coverage, the same 417,000, but just divided it amongst the 3 crops rather than 5 to give you perspective of why diversity matters. So if I only had winter wheat, barley, and hemp, and at that same value, the premium would raise to 35,000, almost 36,000, and that's a little bit higher than the 34. So you can see that there is a 4% or a slightly encouraging diversity if with more or less crops. In fact, with more crops, you get a little bit less premium. And it's not very much in this case. And this is a really critical piece here. You can't just say there's a blanket diversity factor, because it depends on the crops you're growing. Obviously, different crops grown together have different risks, and those crops grown together in different parts of the country have different risks. And so if you change the number and things, it's really dependent on where you live and the things you're changing from. So this is not like a straightforward. I've run scenarios all over the country, and just did some recently for California horticultural crop farmers, and I actually demonstrated a similar kind of a scenario where the diversity factor was up to 15%, shifting from a 5-product to a 3-product farm. So it is very variable, and but nonetheless, there is some incentive for diversity. And again, this is probably not so hard with hemp, and it's whenever you're growing a new crop, you have no price history growing it, so you have to establish what is a viable price from some source. Again, work with your agent about this. For hemp, this is not really going to be a problem because, as we said, if you're contracting, and it's the only way you can insure it if it's contracted, that will establish the price. And I believe that is why they put the contract thing in there, because it's who knows what the markets are for hemp right now. We really don't know any really good national historic prices for hemp. So using a contract price guarantees that we have a price to again estimate that revenue. Yields becomes even more problematic though. And this is from the policy handbook. Must be reasonable, realistic, and consistent with available local agronomic inventory and supported by verifiable records. Well, again, if you're growing hemp for the first time, you will have no yield history of growing hemp. You'll have to somehow find some kind of third-party validation of that. It's usually based on the yields, but that won't be there. Although the people that have been piloting it, if they've been in a piloting state and you've been growing it for 3 years under a pilot program, you will have a yield history. So again, those in the pilot program and with a contracted price are a little bit greater advantage to taking out a whole farm for hemp. And you can also use T yields for the equivalent of those products, but again, there's no T yields for hemp yet. And other sources can be used, like I used the third party from an experiment station. I'm not sure whether that would be approved by your agent or the crop insurance folks, but you're gonna, if you're new to it, that's going to be an issue. Always be prepared to make a claim. And I always say this in every talk I give. If you have a loss expectation, you have notice of you have a loss, tell your agent immediately. Work with your agent. Do not forget. Do not wait too long. 3 days, 72 hours. You're supposed to report those losses. It really behooves you to do so. I would also take pictures of your loss. I would take pictures even before and after. Sometimes, there's going to be an adjustment after you make a claim, and that adjustment has to validate that the loss was true. And so any way you can do to help it's to your advantage. Deadlines for buying this in Montana and most of the northern tier of the United States, that sales closing date will be 3/15. You can notice that the deadlines do depend on when you file your tax forms. Again, this is based on your taxes, so that can be different for people do file taxes differently. They have what they call calendar, early fiscal filers, late fiscal filers, and there's a bit of a difference. If you're a late fiscal file, then you need to have made that decision already, actually. If you're in the lower tier of the United States, the deadline for calendar early is more like 2/28 February. So depending on the country where the county, again, check with your agent. Okay, some take homes. Again, whole farm was not just ideally designed to cover a single crop, although some people have used it for that. And technically we have seen it is possible. But I think what is the unique aspect of whole farm revenue is that it's versatile. You know, they may be, and I think they are working, and hopefully there will be available a single crop policy for hemp, but it will take time because we'll have to establish historic yields, we'll have to establish historic prices to be able to make good, sound ratings for the policy. My gut feeling working in this for you, it's going to take a while to do that. I suspect it will be rolled out in certain states first, maybe only a yield policy at first, and then ultimately maybe a revenue policy, but it takes time. And whole farm is versatile enough to be there for a lot of new crops, and essentially any new crop. So it really does help the specialty grower. Determining the details of policy is kind of like a big information sharing between you and the agent when what they call the accredited, the company that is certified by the RMA to offer crop insurance policies. Again, be satisfied that your historic and your historic experience and your current expectations are met. I mean, if you're not getting, often use a car analogy. You know, if you want to insure the Jaguar and you want to insure it for a high coverage level, make sure you know that value is represented in your policy. If you want to buy a Ford, you can pay less coverage. You know, maybe it's not as valuable to you, but you know, you need to be satisfied that you are insuring it for the value and for the expectations that meet your expectations, not anyone else's. Offers incentive for that diversity again. And so this might be a good way because you could start out not, you know, putting all your eggs in the hemp basket, but maybe trying some out along with other crops. And that might be a good way to get into it and protect your farm at the same time with policy. I might mention that you can mix and match. Even you could, for instance, you can insure your whole farm with a whole farm policy. And then if you have individual crops that are of higher value and there is available policy, you can insure those separate. You can just mix and match and use both policies simultaneously. That's another advantage of whole farm that's often not used. So again, and you might think about that because the idea here is that, remember, you might be growing hemp and let's say it's 10% of your revenue, and you have all these other things that are insured. Let's say all of those things do very well, but your hemp 10% of revenue just totally fails. You may not, depending on the value again of those things and the changes, you might not get an indemnity payment because again your whole farm has done well, even though your hemp hasn't. So again, that's another thought you need to be thinking about. Again, the operating for insurance, you often need insurance for loans. And good rec keeping is good for your bottom line. People have always argued this is too paperwork intensive of a policy. It really isn't all that much more paperwork intensive. You just have different forms, your tax forms to use. Your agent can help you with all of that. There is some forms to fill out like there is with everything, but your agent should help you and can help you with doing that work. So for farm information, I want to point out a particular publication that we just completed. This is related to organic farming, but it does also explore whole farm revenue protection in relationship to organic farming. And it's a kind of funny title, Is Organic Farming Risky? And believe me, it is, as all farming is. But what's interesting is we found that we think through research that may be no more risky than other kinds of farming. But anyway, read the details. We have 19 national policy recommendations, including 7 to further improve whole farm revenue protection. It's 5 years of work. It's probably more information than anyone might want, but if you're interested, check that out. We have a whole website, a section of our ATRA website dedicated to crop insurance now. I'm hoping it to become one of the better sources for crop insurance for specialty and organic and sustainable farms in the country. And we have a number of documents up there already, some of which got outdated very quickly, even though many of them are very up to date. We had this big change in the Farm Bill that I have to keep working on. And again, overall, NCAT offers all kinds of opportunities for information. And please take the survey and questions. It took far longer than I wanted to. I hope it can maybe extend a little longer to ask and answer some questions if you hang in there.
Okay, well, let's get to some of those questions. First off, we have a question that's sort of an informational one, wanting to know when the due date to apply for 2020 is.
That's March 15th in most parts of the country, unless you're in the southern part of the country. And that's only if you're a calendar or, I want to make sure, early fiscal filer. If you're a late fiscal filer, as you saw on that slide, just recheck the slide. But again, go to your agent. I've noticed there's essentially a little bit, because the seasons of agricultural change, if you're near the southern tiers of the United States and counties down there, the deadline's a little sooner. It's I believe February 28th. But generally speaking, in the United States, it'll be March 15th.
Okay.
Of this coming year for 2020.
This question is, let me read this verbatim. Will there be multi-peril crop insurance for 2020? I've heard a couple private companies wanting to offer it and wasn't sure if that is possible. Could you please explain that?
I think what they're saying is that they were hoping that there would be a multiple, what they are saying is, will there be a yield or revenue policy for hemp alone? And that won't happen this crop year for sure. I know that I've heard, I don't know the details, but they are working on a possible single crop policy and not a whole farm policy. And at the earliest, that might be in 2021 for the next crop year. Again, I have my suspicions. It's very difficult to come up with all the data necessary to produce actually a sound product for individual hemp, because you need both. Again, you need yield history, you need price history, things we just don't have yet, and so I suspect they might offer in certain states at first to try it out. I don't really know. I know they want to, and there's some intention to. How soon that happens is your guess as good as mine.
Okay, probably your guess is better than mine, but let's go on to the next.
Maybe.
We'll go on to another question. Can a farmer get gap insurance to protect the proportion that whole farm insurance doesn't protect?
I'm not really sure about what they mean by gap. As I said, you can mix and match. A farmer I know in Montana takes out a whole farm revenue, and he grows about 8 different things. He's a large organic farmer. He grows about 8 or 9 different things, grains and oil seeds. Very interesting farm. He takes out whole farm revenue for the entire farm. And then when there is available, he takes out an individual revenue policy for his wheat. And he does that because his wheat is very valuable. It's certified organic, and sometimes it's a unique kind of wheat, has a very high value. He doesn't want to happen, because he grows so many different crops. Well, what might happen is that all the rest of the farm except his wheat does really well, so that his whole farm revenue doesn't drop below that trigger point where the indemnity kicks in, and he doesn't get any payment, even though he maybe has lost significant amount of his wheat crop. So he puts a little added, he pays extra, of course, and you can balance that. Actually, you can balance that between the two in terms of the costs and the way it works. It gets more complicated, but work with your agent. They can do both. Revenue policy for individual crops like wheat and corn, soybeans is very, very good insurance. And, it basically gives you kind of a set price, a guaranteed price, and almost riskless. No, nothing riskless, but it's a very good policy. So if you have something of particular value and there's an alternative, one alternative would be to mix and match. So maybe that's what they mean by filling this gap.
Okay. Another listener apparently went to the site to look for agents and says he called all of the ones in his state that were listed, and nobody wants to handle whole farm, or
Ooh,
else don't know about it. And I'm wondering if you have any suggestions, any.
whoa, I could get myself in trouble here, but I'll try to be very careful.
Okay.
As far as I understand it, and maybe I know there's some folks from RMA around, and maybe they can chat in to correct me. But as far as I understand, if you are making available federally subsidized crop insurance programs, you are obligated to offer any policy that is sanctioned by the federal government. Therefore, when they say, now they might say they don't want to get involved in it. That's one question. And I guess as an individual agent working for an accredited certification, they, again, may be able to do that. I'm never quite sure about that. But it's true. In that report I showed you, we did a survey of pretty good survey of all the agents around the country about whole farm revenue. It was in conjunction with organic, but we were really asking about whole farm revenue. And many agents didn't like it. And I'll be frank, many of them didn't think it was very good policy. They felt it was too complicated. They were, if you think about it, they were doing good business selling individual crop policies, and they didn't really want to get into whole farm. And then, of course, we had others, some of the examples, who thought it was the best thing since chicken soup for colds, and were willing to sell it and sell it. And you'll find that certain companies that underlie certain individual agents are more prone to it. Different parts of the country are different. It's not highly used in some Midwest states. And because there's so much corn and soybeans, the individual crop policies are fine. Although it's interesting, we did recently, again, in that research, we've shown that farms with commodity crops and with specialty crops, many different kinds of 100 and some different distinct products have been insured under whole farm revenue. So my best answer is that really shouldn't be true. And I would press harder with the agent. And if that doesn't work, there's always a number of regional office for RMA. I would contact them and say, what's going on here? I want to explore whole farm revenue. And I can't seem to find any agents or that seem to want to do it. I don't think they really have that choice. But again, I might be speaking out of place, and anyone can correct me if they want to.
Alrighty. Let's see. We have some folks also talking about. Well, I'll just read this question. If you can't get whole farm, they should check with their local FSA office and ask about non-insured crop disaster assistance program,
Yes.
NAP. We've had a couple people ask about NAP.
Yeah, NAP, non-insured, is really an insurance product, but it's run by the Farm Service Agency. It's a very different. We actually, as you saw, that we have a publication comparing the two products. And I understand, I don't know the details for sure. I've been trying to actually go online and figure out how they're going to handle hemp. I understand they will handle hemp under that program. So that NAP program would be possible. Check out our publication on the comparison between NAP and whole farm revenue. My humble opinion is that in many cases, I find whole farm revenue to offer better coverage for a lower price than NAP. I'll probably get in trouble for saying that, but that's been my experience. It's not that it's not possible to use NAP. NAP generally, historically, didn't offered more like a catastrophic coverage. And again, it's for a crop. It's why it's called non-insured. Again, it's for a crop that doesn't have any alternative. And as you know, whole farm is also can insure, again, with in the context of the whole farm, any crop. So, but it's only specific crop by crop. So if you have a bunch of non-insured crops, you'd say you have lavender, geraniums, and hemp or something, you're growing them, and there's of course no individual policy available in your county for them. You could use whole farm, or you could use NAP individual for each one of those. The other benefit of NAP is, of course, you don't have to have 3 years of history. You can be a very, very beginning farmer. So maybe for the beginning farmer, it will give you some kind of initial support. You can buy what they call buy up. You can actually buy a little bit more higher level of coverage. Historically, it was pretty low coverage. But again, you go to your FSA, check it out. If that's the route you want to go, see what that cost is. Go to your agent, find out what it would be under whole farm, because both of them could be used for the same set of products, and see what works. And again, with that stipulation that if you're not a beginning farmer and or don't have 5 years, then NAP is your only alternative.
Okay. This listener is, I believe, referring to the fact that to get the whole farm revenue on hemp, you have to have a contract
Correct.
in place. And this listener is wondering if there are any policies, or if whole farm, in fact, protects farmers and ranchers from broken or unfulfilled or abandoned contracts.
I wish it were true, but it's not true. There has been many cases. I know of a case that was reported in Montana Public Radio here in Montana, where I forget the number of farmers last year all used the same contractor and had what was reported up to $7 million in losses because the contractor reneged on the contract, and it's in legal limbo at the moment. And this is a joint effort of North Dakota and Montana, the state departments of agriculture, suing this contractor. So be very careful with the contractor you use. Make sure you feel comfortable with them. But no, again, that is not the responsibility of the crop insurance or the federal government, other than these other methods, laws and other, which are not a fun place to go. So try to establish yourself with a good contract, trusted contract, make sure they're a viable person to buy your product.
All right, well, I think we've reached the end of our time that we have for the webinar today. Do you have anything to add, Jeff, before we?
Well, if there's if you see any other pressing questions, I know I went too long. I was intending to go less. I get carried away as usual. Again, it's new. The 2018 Farm Bill, introduced hemp, made it legal interstate commerce. It had to take a long time to get the details and the rules out, and that's very new. Again, October 31st is just the rules and regulations about growing it, which I know is very confusing. I think it's great that we have whole farm revenue available. It isn't ideal necessarily for just an individual hemp grower, but I think what I like about it is whole farm has got this versatility, and it really orientates you to think. I always think, what is the kind of general overall basis of insurance, of crop insurance? Is, will it protect me enough so I can continue to be in business and be a farmer? That's what, to me, I think hopefully this federalized program will do. It will help people sustain being farmers and making reasonable livings and protect them against all the dangers and risks of growing. And whole farm says, grow what you like to grow what you think is profitable, and then protect your revenue. And it's a very different way to approach insurance, but it also, I think, frees up the farmer then to make choices about diversity and ways of growing and new markets, and gives you a level of creativity that's not available from a lot of other crop insurance programs. And so just explore it. It's not been used that much, but just go get a quote, find out if it'll work, and we'll hopefully keep making it better and better. It's my goal. Anyway, thanks for everyone for coming.
Yes, absolutely. Thanks for everybody for viewing our webinar today, Crop Insurance and Hemp, a whole farm approach. And if we didn't get to your question, once again, we will in the days to come. We will round up all the questions and get them answered for you. And don't forget to check out ATRA's website, where this webinar will be archived once we get it recorded and ready to go. So if you need to, you could listen to it again. And check out all our other resources while you're there. The website is right there on your screen as it is. And finally, please stay and do the survey that you'll receive, as soon as the webinar is over. It's a very important part of the process for us. And thanks, Jeff.
Thank you.